And the VIX is under 12. The VIX is under 12. The VIX is under 12. The VIX is dead. But could be the Undertaker and come back in 6 months, 12 months, 18 months, 24 months, at some point in time. From, basically 2012 through about 2019, we went through what I would call a peacetime stock market. It was a peacetime stock market from about 2012 all the way through to to basically the end of 2019. It was a peacetime stock market. We had a few fluctuations here and there and a few little scares, but it was overall we had about an 8-year span of a peacetime stock market. And the fact is the VIX is even lower right now than it was during a lot of that peacetime stock market, which is crazy to me. It's hard to get a recession if people just keep spending, right? You really think about it, right? I mean, if everybody just keeps spending all the time, well, how do you get the job losses coming? Because businesses aren't doing as well, right? But if people just keep spending, then the jobs will stay there. And so you kind of need something to happen where credit completely dries up, which would be some sort of huge event, or you need people to make decisions that I'm not going to spend. It's really hard to get a real true major recession with major job losses if the consumer keeps going out there and spending. And when you got the fiscal spending going on, it's difficult. It's really difficult, right? Howdy, folks. Hello. Hope everybody's doing tremendous out there. Let me get everything up and rolling. And we're having some good discussion there about small caps and whatnot.
Speaking of energy, which you've liked, are you still on that train? Or are you about to hop off?
Two things. One, parse the quality thing a tiny bit, which is, I think, in growth stocks, you want high quality. And that's 2/3 of the battle if you're trying to beat the S&P.
A lot of the other stuff has rallied a ton, though.
I think in growth. And think in value stocks, you don't necessarily over time want high quality. You want future quality that doesn't look like it today. So when you define it systematically, you don't want quality across the board. You want growth quality over time. In terms of energy, look, my view is that we're short being able to produce 107 million barrels in 5 or 10 years, and the path toward getting there is unclear. So I think ultimately demand will exceed supply. The thing that worries me tactically is the same thing what worries everyone else, which is Hess sold to Chevron without a premium. And so when you start thinking about it, probably knows his assets better than they do, and he probably thinks he can sell it without damaging Chevron stock as much as damaging his own. This underneath tactically, it's not great, but I don't see how we get 107 million barrels down the line. So ultimately, we're going to have much higher oil, but the path from here to there can always be filled with 19 hard to predict variables. So I like it long term, but I have no idea about 3-month view.
But when you're talking about quality growth, so I know we've been obsessed with Magnificent Seven, and the performance has been incredible, but of late, all those other growth stocks have done incredibly well. Like the archetype names they just had their best month ever in November.
Right. Well, when the bond yields come down, she's spot on.
That's
You have
true.
the highest correlation you've had in years between negative if you look at yields versus equities. What happened is all the riskier companies where more of the value is way out in the future, they go up because their cost of capital kicked
Sure,
out.
but what if rates stay lower?
Well, we didn't pre-prepare, and I usually disagree with people, and it gets a little awkward. In this case, we agree a lot because I think if they plummet, it's because the conditions in the economy got much worse, and it's really a risk.
If rates plummet,
if the 10-year yield goes to 3 or 2.5 in a hurry, that's because things get bad.
Of course,
if it stabilizes where we are here, maybe the 2-year comes in, you uninvert eventually. That I think could be very supportive of higher multiples for equity. So I think that's where, I agree. If you can tell me the exact mapping of the 210 level and slope, I could probably do okay picking stocks.
What about one thing we have to do, though, anytime we talk about growth and value, explain what you mean by growth and value. Are you talking about indexes? Are you talking about the factors of growth and value? If you remember, we may have talked about this mid-December last year when S&P did their rebalancing. The mega cap 8 were all in S&P's pure growth index. On December 19th, the day of the rebalancing, only one was left in the pure growth index. Tech went from being 37% of that index to 13% of that index. Energy became the highest weighted sector in S&P pure growth. In part because of that, Russell 1000 growth is up 37% year to date. S&P pure growth is up 2% year to date. So when people just say growth and value, I always think, what are you talking about? Are you talking about the characteristics? Are you our preconceived notions of what are growth and value? Even if you're talking about the indexes, what indexes?
Yeah, we're at Trendway, we're nerds, right? It's all systematically assigned. It's mutually exclusive and exhaustive, and you can't both be in growth and value like Russell used to have with Exxon or whatever. So for us, it's not that shocking. I mean, if you grow fast, you don't have a dividend, you don't need debt, you're expensive, you're a growth stock. So it's all systematic, but it's probably pretty
The problem
correlated.
is that if you're not a growth stock, you're put in a value index, necessarily offer value.
It's funny, we
You're
do
just
it.
not a growth stock.
We do it for this reason in thirds. We have like a growth, neither, and value, because I think that neither zone is a little bit different. But, so I think we're getting the same answer, maybe showing our work a little
What's the point at which, Lizanne, I'll ask you first, that money comes out of money markets and then goes into equities, and that sort of spurs the next leg of whatever kind of market, whatever kind of bull market this may be, if in fact this can hold up?
But
Are we
equity
approaching
flows have
that
been
point?
strong too. So I'm not sure a lot of the money in money markets is the traditional sideline cash that's itching to go into equities.
Really?
Even this time where you know
Really?
there's so much money in cash?
Come from maybe other areas, typical deposits, other areas even within fixed income or the equity market, where a lot of income-oriented investors saying, now I can actually get 4 or 5% in a money market. There was that sort of similar size in relative terms of capital in money markets in the 90s, and it didn't leave. But you had a strong equity market, and you had sort of this meaty amount of money in money markets, and I'm not sure
I mean, the great thing about that money market money over there, which is a crazy number, I'll show you a chart in just a moment, it makes you sleep well at night because there's so damn much money.
some moment in time source that's going to fly into the equity market. I think it's probably pretty.
The world's so much different than it used to be, where you could really bank on these flows from cross-asset allocation or regional allocation. I mean, pick one multi-strat or pod shop. Pick any one. They have 35 quant teams. Those teams are running 600 to 1,200 gross exposure, hundreds of longs, hundreds of shorts, and they have 3-hour to 2-day holding period. Like, that's what's happening.
Yeah, maybe this time is in fact different. Like, we know that because rates were so elevated, that putting your money in a money market where you could get 4 or 5% was so much, the risk reward on that was so much better than taking what was tremendous risk in equities because of the Fed's regime of hiking. If we know that there was an outsized amount of money that went into money markets, if the coast is deemed clear, why wouldn't that money go in? And by the way, maybe it goes to bonds too, if you think that yields are going to continue to come down and bond prices are going to go up.
Yeah, I mean, I think there's two different issues. Like, it's all horizon, right? I mean, I don't know any actual human being who buys the 10-year and holds it to duration. Unless, well, my clients are like people who are institutional equity investors with a 12-month holding period, or so. Right, but when you run like 30 trillion or whatever, and then there's going to be trillions that are holding it. But like, to me, I could see somebody saying, I'll buy it tactically or something, or I could see it holding the 2-year or something like that to duration to pick it up. But to me, that's like a small part of what's. You asked about inflows into equities driving a much bigger equity.
Also, keep in mind, though, for all the talk about the record amount of money in money markets, as a share of equity market total capitalization, it's fairly small. So the firepower has to judge with that ratio in mind, not just the dollar level of what's in money market funds.
I'm going to leave it there. You guys are great.
It's a good
So
point
much
by
fun
her.
having
I
both
like
of you
her.
here.
She brought some good
Lizanne
points.
Saunders.
Happy holidays.
Of course, to you both as well.
Thank you.
Thank you. We'll talk to you again soon. We're just getting started here on Closing Bell. Up next, a must-see exclusive, Goldman Sachs president and COO John Waldron. He joins me right here at Post 9.
I wanna see that.
His exclusive take on the markets, the economy, the Fed, and the firm. Just after.
Yeah, I want to see that because Goldman Sachs is kind of bearish on the market for next year. And so I'm very curious on what that gentleman has to say. But anyways, they were talking about money market funds, and it is an astronomically high number right now. Yeah, over $6 trillion is over there sitting in money market funds right now. So, I just think it's something that should give everybody a little level of comfort, right? That all that's over there. And if we do get any major dips, there's going to be a certain amount of that, right? Not all of it, but there's going to be a certain amount that would eventually come into the market in some sort of situation like that, right? And if you look right here, massive dip down. And the reason there was that massive dip down there, I think, was twofold. One, stocks got plummeted. And so a lot of people probably looked and said, I want to buy stocks. I want to put some of that money in the market. The other reason is, obviously, interest rates dove massively, right, to near nothing. And so people took their money out of money market funds and put it elsewhere, right? And I think some of that money, once again, I think it went in the market. Then we were stuck at $3 trillion money market funds for years. Literally, look at how long. It was almost a little shorter than a decade. We were at $3 trillion. I mean, basically, from about 2010-ish, 2011, all the way to about teen, folks. We were stuck at about $3 trillion roughly in money market funds. Think about that for a moment. That's pretty wild. That's pretty dang wild. And then finally, we had this kind of boom here going into Rona. And then, after Rona had another big boom up there for money that's in money market funds. So interesting. Now, yeah, that's a really interesting comments about China being so weak. And so I think one of the upsides is, for 2024 is China economy starts to improve. And on top of that, the European economy starts to improve because inflation doesn't hit as hard. The European economy in 2024 and then also in the US, right? And so maybe you can see a real wage uptick. And so that would obviously be tremendously helpful if those things played out for us in 24.
That having more of an impact here. You used to say, well, China sneezes, the rest of the world catches a cold. Now it seems China's got a pretty good cold, and yet here we are.
Well, the U.S. consumer is still, to me, the most important factor in terms of U.S. economic performance, not necessarily the U.S. consumer.
100%.
The U.S. consumer, as we talked about, is doing well. By the way, Europe is having a tough time. European economies are not exactly firing in all cylinders. So I think some of what we're seeing in China is impacting other economies. I just think the U.S. right now is really outperforming because the U.S. consumer is surprising everybody in terms of the resilience and the spend.
Let's talk about the markets as it relates to your business directly at Goldman. We keep wondering when we're going to see this new flood of M&A. What sort of pent-up demand do you see, Mike?
All right, so
Be delivered to LPs, so I think that's an...
yeah, that's the problem is, it's hard to get a recession if people just keep spending, right? You really think about it, right? I mean, if everybody just keeps spending all the time, well, how do you get the job losses coming because businesses aren't doing as well, right? But if people just keep spending, then the jobs stay there. And so you kind of need like something to happen where credit completely dries up, which would be some sort of huge event, or you need people to make decisions that I'm not going to spend. It's really hard to get a real true major recession with major job losses if the consumer keeps going out there and spending. And when you got the fiscal spending going on, it's difficult. It's really difficult, right? So anyways, let's see what's going on here. Yeah, Meta's really helping the NASDAQ out big here today because a lot of the other big dogs aren't really helping out that much. Holy smokes, what is going on with their webpage here? Microsoft's up a little bit, Apple's up a little bit, Nvidia's up a little bit. Well, decent. Amazon's up a little bit. Tesla's actually down, but it's actually Meta pulling through really strong here today. So that is good to see. So that's why I'm not invested in Enphase. Well, really, I'm not, I don't know, it's a tough business. The solar business is a tough business, and Enphase has really went through a boom time there with their business model, and I'm just trying to figure out where solar is really going. And, even was at a holiday party, Christmas party. I was at a Christmas party a couple nights ago in the neighborhood, and, even some neighbors started talking about solar. And keep in mind, I live in a very wealthy neighborhood. So, for somebody to spend on solar is not like the biggest expense to them, right? But even these people were saying, it's hard to justify it. That's not a good sign. That's not the type of conversation you really want to be hearing, that even people in a wealthy neighborhood are having trouble justifying the cost of putting a solar system on their roof in Las Vegas, right? So I don't know, man. That's just still trying to look into the industry and trying to figure out, is it worth it? Is it not? Because if that stock takes my money, then it's money that's not going into other stocks, right? And maybe there's other much lower risk profiles out there that have better rewards. And so that's just something I'm trying to figure out right now. Somebody said, are you investing in anything privately, like not in the stock market? Not that I can think of, really. I just focus my attention on real estate investing and stock market investing, right? Stock market investing takes up the far majority of my attention. Real estate investing takes up a very small amount of my attention, and that's good for me. And then you can also get money in savings accounts right now, or treasuries, 4 to 5%. So that's where my time is, earning interest on your money, stock market investing, building your wealth that way, and then real estate investing. The rest of it, it's just not even worth my time and attention. Somebody says, that's fair. My argument is that you're investing in Tesla, which Tesla's solar business is a joke. There's nothing, I don't care anything about Tesla's solar business. Are you kidding me? That's a joke. That's not even a top 5 most important thing at Tesla, just to be honest, is solar. I said years ago they should get out of the solar business. I said that years ago. I said they should dump out of that solar business. They lose money on it. It's a waste of time and attention for the team. I said they should get out of that business years ago, and I've been 100% right on that. They should have. That's just a distraction for them. They should have nothing to do with solar. It's a money suck for the business overall. Their time and attention for how talented that team is, there's better opportunities out there for them. Let's see. Somebody says, isn't Enphase one of the stocks leaving the NASDAQ? I don't know about. So Somebody said, did y'all hear about Chinese cyber attack? I don't know. There was some stuff on Twitter about that. On Twitter, you never know what's real, what's not real, what is exaggerated versus like, whoa, this is serious. So, I mean, Twitter is going through a time period, so there's going to be a lot of headlines on Twitter that are very out there, and just to try to get attention and engagement on the platform and people sharing it and things like that. So it is something to kind of keep in mind. You got to really look into these things and find out how serious is something or not serious, right? So anyways, I'm not going there. Somebody says Tesla battery business. Oh yeah, Tesla battery business. Now, that's a beautiful business. Somebody asked if I'm still thinking about BABA. I am still thinking about BABA. I should be on my potential buys watch list here. And where is BABA at? Wait a minute. It's got to be here. We don't have BABA up here yet? What in the world? Did I forget to add BABA? Oh my gosh. I didn't even have BABA on here. I want a BABA. Here we go. Now we got BABA up there. Okay. So there's BABA. Well, about flat here today. But yeah, I am still considering BABA. So Bitcoin slightly down, GSG down very nicely, Ethereum down. I love that crude oil being down. And the VIX is under 12. The VIX is under 12. The VIX is under 12. The VIX is dead. But could be the Undertaker and come back in 6 months, 12 months, 18 months, 24 months at some point in time. But the VIX for right now at least, holy smokers, that's no jokers. It's under 12 on the VIX. Last time it was here was January 2020, prior to Rona. Wow. Look at the VIX. That baby's dead. Wow. I'm just like, that's a really low number, folks. Under 12 where it was just trading. Because here's the thing. From basically 2012 through about 2019, we went through what I would call a peacetime stock market. It was a peacetime stock market from about 2012 all the way through to to basically the end of 2019. It was a peacetime stock market. We had a few fluctuations here and there and a few little scares, but it was overall we had about an 8-year span of a peacetime stock market. And the fact is, the VIX is even lower right now than it was during a lot of that peacetime stock market, which is crazy to me. I mean, this was kind of ultimate kind of peacetime stock market. September 2017, we got a VIX under 10, which is, I believe, that should be the lowest number in the history of the VIX, right there. That was the lowest number, at least in recorded VIX history, was in that September 2009 right there. September, October. And we got a VIX under 10, which is extraordinary. And you got to wonder, could we go back there? There's a potential. But we really need this peacetime to continue through. And I'm a little concerned about a sell-off in Q1 at some point in time. So, someone says, thinking of selling cake and buying PayPal or Palantir. Oh, interesting. Yeah, a lot of that comes down to a couple things. Sometimes you got to ask yourself, do you feel like you need to make a move just because you need some action, right? Like if you really like a stock and, sometimes I think people feel like they need action. They need to make a move. So I need to move money out of this stock and move it into this stock. And I think that sometimes plays with people's minds. And then the other thing is if you don't have any, if you're not on a consistent buy schedule, like buying stocks every week or every 2 weeks or 3 weeks or something like that, sometimes people see another stock and they're like, oh, I want to put money in that stock rather than just wait until the next time you can buy with fresh capital, right? With income. So sometimes you got to ask yourself things like that, right? So it says VIX bottom, storm is coming. I don't know. We'll see. But like I said, you can have a very good market with a VIX in a lower state. Like I said, 2012 through, the beginning of 2020 was a very time stock market. Performance was very good. There wasn't a ton of drama. And, it didn't mean we had a spike back up huge. I'm trying to remember, this was 2011. I'm trying to remember, maybe we had double dip recession fears around this time. I don't remember why the VIX spiked so huge right there. It might have been double dip recession fears, right? Then we had a spike here. This was summer 2015. I got destroyed summer 2015. Destroyed. Oh, it was ugly. I was doing a lot of trading activity, margin trading, crap like that, and stuff I shouldn't have been doing. I got wrecked. Summer 2015, it was ugly. It was Red Dead Redemption out there. Ugh, don't remind me. And then right here I got hit hard. That was late 2008. Ooh, man, got smacked around. Apple, Nvidia, Meta, everybody was just getting slaughtered late 2018. Woo, did I get slapped around in that market. Woo-wee. Ugh. We had this massive spike up. This was obviously the Rona drop. And that was pretty debilitating for that kind of March time frame. Woo, man. It was like every day you woke up and your account was just down an astonishing amount of money. It was crazy. But they came back really fast, so that was the fun part with the Rona crash. Right. Then we had, other Rona-related crashes here, September to October 2020, or VIX spike-ups, I should say, not necessarily crashes. And then obviously we had VIX spikes last year with the Fed starting to raise rates, volatility, those inflation numbers that were coming in last year, scaring the crap out of people, right? And then since that time period, you've had some spikes here and there. You had SVB. But the problem is everything we've had recently has gotten less and less in terms of its scariness, right? Like, right here is max level scary. Oh my gosh, we're going to close the economy for 3 years. Oh my gosh, everybody's going to go bankrupt. What's going to happen here, right? Then you had lesser fears about like, oh, there's a new variant. It could be more serious, hurting people, things like that. But it still wasn't as scary because we're like, okay, we've already seen like the scariest part of this. So now it's less scary, right? Then you get into, oh, Fed's raising rates. What's it going to mean to the economy, recession fears, things like that. Okay, that's scary. But that's still way less scary than the economy having to be closed for years, like they were talking about, and us losing 10, 20% of the population due to Rona, which is what the thought process was in March 2020, right? Then you go to SVB, and it's like, okay, yeah, some regional banks went under, that were leveraged to this or that. Still not as scary as the Fed raising rates, right? And obviously not nearly as scary as this. Then you had the Middle East stuff. Well, then you had actually Russia-Ukraine happen before SVB, and Russia-Ukraine was scarier than SVB in the regional banks. So you had another kind of leg, like, oh, this isn't as scary. Then you had the Middle East conflicts recently. Well, Middle East conflicts aren't nearly as scary as Russia-Ukraine was. So this is why the VIX just keeps going lower and lower, because everything that happens it's less scary than the thing that happened before. And so you see a little short-term spike in the VIX, but ultimately it's not nearly as scary as that thing. And you can really see this play out on a 5-year, right? You had max level scary, then you had less scary, then you had less scary, then less scary. And it's just kept going on like that, right? So at some point in time, we'll get back into a market where the things get scarier and scarier, and, as we take along. But who knows when that could be? That could be 6 months from now, 12 months from now, 18 months from now, 24 months from now, 36 months from now, 48 months from now. We don't know when that is, but at some point in time, you'll get into a reacceleration of like this scary thing happened and this happened. But for the last several years, it's been less and less. So just a little food for thought.
It's the second straight quarter. Oracle failed to impress, and that's why you're seeing the drop right now. Last time was 13% after post-earnings, but they failed to meet their cloud growth expectations, even though I have to say it grew 52% year over year. Street wanted 57%. The company blamed the pace of infrastructure buildouts and lack of GPU data center capacity, with the CEO, Safra Catz, saying on the call, we're talking about hundreds of millions of dollars that we would have been able to recognize if our capacity was available. And then you also had Chairman Larry Ellison say, it's a matter of supply and not demand, and believes the cloud infrastructure business will keep growing past 50% just over, quote, the next few years. That shows a theme, Scott. Access to NVIDIA GPUs is the difference between beating and missing in the public cloud business. But it wasn't just the cloud for Oracle. You had the November print also fell short on software as a service revenue, total revenue growth, CapEx, revenue guidance for Q3, and cash flow. Oracle, though, aims to compete with Microsoft Azure, Amazon Web Services, Google Cloud. But as UBS puts it, Oracle is testing investor patience, Scott.
All right, Christina, thanks for everything today. As always, Christina Partsinevelos. All right, Leslie Picker. Now, what am I missing here? I thought a lockup expiration was supposed to be bad for shares, not up 20% like Kava's up.
Yeah, that's definitely the conventional wisdom.
Weird.
Up 20% right now.
That's very strong.
It's a relief rally, essentially, related to that lockup expiration this morning. It's been 6 months since Kava's IPO, and therefore restrictions on the 97 million shares that weren't floated on day one are now lifted. To your point, lockup expirations, especially for these highly volatile new issues, can pressure stocks in the weeks and months leading up to them. Kava's 69% short interest, though. That's as a percentage of float, largest in the restaurant sector, according to S3 Partners. The research firm said Kava saw more than $30 million worth of new short selling over the last 30 days, despite its lack of loan availability and expensive borrow costs. So it's likely that today's surge in the shares is due to a just traditional technical short squeeze. Shares are now more than 70% above Kava's $22 per share IPO price, but they did double on day one in mid-June, so down a little bit, down about quite significantly from that, Scott.
All right, Leslie, thank you very much. That's Leslie Picker following Kava. You heard the sound effect, which means we're within the 2 minutes now before the
Interesting. So Michael says, I'm waiting until under 100. Interesting. Okay, in terms of Oracle there.
Or is that the broad view of the
Oh yeah, somebody's asking, do I ever have other people invest my money? No. I invest all my own money in real estate and stocks. I don't want anybody else, if I'm going to die, I'm going to die on my own sword when it comes to investing. I don't have anybody else manage money for me, real estate, stocks, anything like that. I manage all my own.
Going to be, and here's where we think unemployment and all the rest of it. So it would be consistent with Waller's view to say, we don't want to become incrementally more restrictive as inflation goes down. But again, I think
Zoom's down 71.
The takeaway is going to be no hurry to make a change. Longer rather than higher is now the mantra. And I think that the Fed funds futures pricing stuff in is a little noisy at this point. If it's beyond a couple of months, it's really noisy. Let's remember, in March of this year, after SVB, we're pricing in 3 cuts by the end of this year.
Ooh, plus 14,000?
6-8 month span. So
I'll take it if that's true.
Stocks, by the way, are up 18% since March. So it shows you that it's a little bit of a one-week exercise as opposed to progressive. I think the market's
Flip some flapjacks, folks. Flip some flapjacks.
Into the close as well. So the NASDAQ is going to be outperformers today. I can't wait for tomorrow. Gun block, following Chair Powell. It's going to be a big one. I'll see you then. In the OC. Morgan and Johnny.
By the way, we're going to take a look at Oracle's valuation here in just a moment and see if we might have something intriguing there. But let's see. So, the 4% revenue growth on a constant currency basis was really concerning for people. Now, the management team saying, hey, you know what, that's probably going to be stronger than that, blah, blah, blah. But, the bottom line is it came with 4%. So people are just looking at that as not too happy. So, based upon this year's expected numbers, trading at about 20 times forward P, based upon next year, 18.5. And then revenue growth expected to be, 7% this year and accelerate to 8% or so the next year. So, I think it's a moneymaker. I think Oracle is probably a moneymaker. And probably a pretty good moneymaker over this next 3 years, for instance, right? But with that being said, remember, in the stock market, it's not just about being a moneymaker. It's also about the risk reward, right? And the risk with Oracle is, they're talking about they should do this, do that, but the bottom line is the numbers have been a little underwhelming, and it does carry a huge debt load. So that's kind of the risk with Oracle. And the other thing I think about is, are there companies out there that are better growth profiles, less risk, that ultimately should have money? So for instance, Meta stocks performed tremendous this year. We all know it. But here's the deal with Meta. Based upon next year's numbers, it's trading technically lower than Oracle. But here's the deal. Revenue growth is supposed to far out Oracle. And if we compare Meta's balance sheet to Oracle's balance sheet, they can't even be compared because Meta has a far superior balance sheet than Oracle does. And it's not even close. And so that's where, you have to get into very tough decisions in the stock market. And you have to look at these stocks and say, well, this one might be better than the other one. On the flip side, if it was somebody like myself, well, Meta's already too big of a position for me. It's already 30% plus of the public count. So I'm already kind of overexposed to Meta in general. So if anything, I would probably have to look to something like an Oracle. But we could also say, okay, let's say it's a brand new stock. Well, what about a Google McDougal, who could be arguably being disrupted right now, by the way, by ChatGPT and kind of what's going on there. So that's a whole different argument to be made. But bottom line is Google McDougal trading about 20 times next year's expected numbers, right? Which is, let's call it roughly in line with Oracle. But revenue growth expected next year of 11% versus analysts are at about 8% for Oracle, right? And once again, a Google McDougal balance sheet is creme de la creme. It's a top 5 balance sheet in the world. It's top 5 in the world. Oracle has a worse balance sheet probably of all big tech-related companies. So that's something to be considered. You can even say, okay, what about a new position in something like an NVIDIA versus, let's say, an Oracle, right? NVIDIA trades, let's call it 23 times next year's expected numbers. So we're talking about a little premium versus an Oracle, but we're talking about 50% plus revenue growth expected. That's what we're talking about, right? This is where you get into tough decisions that have to be made. So if I'm going to build a new position in the public account and I want something big tech related, this is something I have to consider. I have to consider, do I really want an Oracle instead of a Google McDougal? Do I really want an Oracle instead of an NVIDIA? And these are tough decisions to be made, right? So, and you look at an NVIDIA, you say, okay, if you were to compare performance the last 10 years, not just on the financial front, but just the overall business, how they've done running the business, how Jensen's done run that business the last 10 years versus how Oracle's done running the business the last 10 years. NVIDIA's smoking them. They're smoking them, right? I mean, the stock will tell you everything. NVIDIA's up 12,000% in the past 10 years. Let's see Oracle in the past 10 years. The stock will tell you everything on how a company's actually done the past 10 years. Oracle's up 177%, which, by the way, isn't bad. Like 177% is okay. But there's a difference in how these businesses have really been run, right? In what company's really special versus what company's okay. You don't get a 12,000% return in 10 years unless you are special. NVIDIA's special. Jensen's special. What they got going on there is special. So anyways, that's the tough decisions that have to be made in the stock market overall. And that's the fun. That's the fun of this game, man. It's the fun of this game. I'm trying to figure out, what I want to be in, where I want to be positioned, not. So interesting in terms of the inflation numbers broken down. This is the numbers broken down. Juice and drinks up 18.6% year over year. What in the world? Orange juice. It's got to be orange juice. Cooked beef roast up 12.5%. Okay. Sauces and gravies up 8%. Baby food and formula up 7.6%. Sugar up 6.8%. Crackers and bread up 6.5%. By the way, sugar, if that just kept going up for all of eternity, that would probably be the best thing for our health overall if sugar got really expensive, because then we would probably not have as much sugar, right? From vending machines, wow, 14.6%. That's interesting. Electricity, 3.4%. That's a big cost for people. That's the stuff I would like to look at. I like to say, okay, what is actually taking people's budgets? The thing that takes people's budgets are mortgages, rents, electricity, autos, and phone service, right? Like if I think about like where do people's monies actually go, that's the stuff it goes to, right? And insurance as well. And motor vehicle insurance has been a huge problem for us in 2023. I do not think that number is going to be nearly as much of a problem for us in 2024. So that's good news in regards to that, in my personal opinion, right? But overall, obviously we're at 3.1% in total. So interesting. Healthcare related services, man, just always going out of control. Out of flip and flapjack in control. Gasoline prices. Did I talk about gasoline prices? Well, I'd kind of almost put that into electricity category. Let's just call it, the need for heating, air conditioning, and, to drive your car somewhere. Because most people drive internal combustion engines. That's obviously in a good place. So, all right, folks, that is going to wrap up my live stream for today. On Thursday, we're going to do a 3-hour Beast live stream. And the reason we're doing a 3-hour Beast live stream on Thursday is because Costco's reporting after the bell. And so I want to react to all the Costco numbers that come out, and then I want to actually listen to a conference call live on here. And Costco is a company in which, I think it's a very important company to listen to their conference calls. One, they're a very well-run company, so I think you can learn a lot from the business front and like what a really well-run company is talking about, how the management addresses questions, things like that. But the second component is it really lets you know how the consumer is doing, right? Because they have just so many shoppers, obviously, that shop at Costco. They can give some good intel on how the consumer is feeling. And because this earnings period is so close to Christmas, right? The earnings are going to come out on the 14th. Conference call is going to be on the 14th. We're going to get the best gauge for how they're actually feeling about the holiday season. And I think we're going to be able to understand, like, is this a strong holiday shopping season? Is it not a strong holiday shopping season? Is it a meh holiday shopping season? Like, what's actually going on there? And I think we're going to get a lot of good info in regards to that. So anyways, guys, appreciate you joining me. Thanks so much. Much love as always. Appreciate each and every one of you for always showing up for these, and take advantage of deals, build your portfolio up, and peace. Have a great one.